Great. Thanks. Okay, so here we are, budgeting for your projects, uses and sources of funds, and projecting cash flow. So you're in the right place. We're excited to get started today. All right, next slide, Deanna. We'll do a little bit of an overview of what we're going to talk about today and make sure that these are the topics that you're interested in learning more about, and we'll talk about them in some great detail. So first, we'll start with introductions. We're going to do sources and uses of funds. We'll talk about projecting cash flow. That includes some information on key assumptions and how you build those out. Then we've got a good amount of time set aside for questions and answers. We want to make sure that if there are particular scenarios you're thinking about, if you have some specific questions about a plan or an idea that you're working on, we really want to set aside that time for you. Then we'll talk about next steps, and that includes some additional upcoming webinars we have to help you with next steps with your business or your project. Next slide, please. All right, so let's start with meeting our team here at the Shared Ownership Center at Nexus Community Partners. So our colleague, Benjamin Tsai, is the director of the Shared Ownership Center. Benjamin is part of our team and has a background in worker ownership as well. Benjamin also does a lot of work in real estate cooperatives, and that is his primary focus in our day-to-day work. I'm Christina Nicholson, glad to be here today. I'm a cooperative developer. Diana Siegel Garcia is here today. She's our program manager and helps us hold it all together. And Patty Biafra is also here. She's our director of the Worker Ownership Initiative. Patty's on the call today as well as we get into questions and exploration of this process. She and I will be here to help Mara answer any questions as it might directly relate to cooperatives, cooperative businesses. Next slide, please. So we wanted to take a moment to also introduce you to our colleague, Mara O'Neill. Mara's been a consultant and a fantastic partner with Nexus Community Partners and specifically the Shared Ownership Center for a number of years. This slide talks a little bit about the vast amount of knowledge and professional history that Mara brings to this work. High level, Mara brings over 4 decades of experience. She's worked for the Metropolitan Consortium of Community Developers. She's worked as the Director of Capital Investment for First Children's Finance. She's been Chief Operating Officer at NDC. She's also worked for the St. Paul Department of Planning and Economic Development. Mara has a deep bench, and so she's going to be holding the center of today's presentation and walking you through the majority of the material we'll be presenting today. And we're really lucky to be in partnership with Mara. Next slide, please. Okay, so we also want to learn a little bit about you. So in the chat, please drop in your name and preferred pronouns if you choose. We'd love to know if you're here from a cooperative or an organization, or if you're in a self-learning space and you just want to learn more about a project or idea that you're working on. And then if there's a specific piece of information or a specific idea you're exploring, if there's something you'd like to take away specifically from this workshop, we want to focus on any specific material you're trying to access, and we can focus on that in questions and answers and try to make sure that we honor your interest in being here today. So please drop those in the chat if you're able and interested, and we're really glad that you're here. We're going to get started. All right, next slide, please. Okay, the last thing I wanted to share before we get started with Mara is our training roadmap. So for some of you, you may have attended some of our other webinars. For some of you, this may be your first webinar, so welcome all. We here at the Shared Ownership Partner, as part of our local fund partnership with the City of St. Paul, have built out a webinar series, and today is webinar 5. So we have built out a whole arc of trainings. They are available on our YouTube channel. Today's webinar is number 5, as I said, projections, sources, and uses. So if you're curious about how to start, maybe from the idea of iteration of an idea all the way through the basics of building out a sketch of your business, and then maybe building up to the more concretized projections, sources, and uses, feel free to go back and look at some of those other videos. We have 2 more in this journey after today. The next webinar is on June 18th, which is Wednesday. We'll be closed for Juneteenth, which is that Thursday, June 19th. And then the final webinar is how to apply for the local fund. And again, this entire arc of webinar is sponsored with City of St. Paul Local Fund. And we'll talk more about that at the end of the presentation, and that's June 26th. All right, next slide, please. Let's get to the part that's interesting. Mara. So thanks everybody for being here. It's my pleasure to turn it over to our partner, Mara O'Neill. Mara, lead on.
Thank you, Christina, and welcome everybody. It's good to be here talking about some of my favorite topics with you all. So as Christina mentioned, over the course of the last 2 months, we've been delving deeper and deeper into the various steps involved in business planning to start and expand a business, whether or not it's established as a cooperative. We've talked about financial statements. We've talked about Patty talked about conversions at the last webinar, where a worker co-op forms, employees form a cooperative to sort of purchase a business from an existing business. And today we're going to delve deeper into the financial plan of a business plan. And basically we're going to talk about 3 things today. Sort of the uses and sources of funds, basically a project or a startup budget. We're going to talk about projections and why they're important and how to actually put them together, specifically monthly cash flow projections. And then we're also going to talk about the importance of keeping track of all of the detailed assumptions for those projections. Next slide. So as we're developing that startup budget or a project budget, there are a number of questions that we want to ask. And the main one is, well, how much will the project cost? What's involved in it? And then where will the money come from for the project? And then ultimately, I think one of the most important questions to ask is, will this project allow the business to be profitable? Is it something that is going to have a positive impact on the business? Next slide. So what we're going to talk about first is the uses and sources of funds. Now, it's also called sources and uses of funds, also called the project budget. I think lenders, banks, I know, usually talk about it as sources and uses of funds. I prefer to use the uses and sources of funds title because you don't really know what funds you're going to need until you figure out what you're going to use the money for. So as it implies, it consists of 2 parts. Uses of funds, basically what you need to purchase to complete your project, and the sources of funds, where you're going to get the money you need to pay for all of these uses. And one thing that's really, really important is that the uses must equal the sources, because you really should not start a project until you have all of the money you need to finish it. Next slide, please. So we're going to go forward and look at a couple of sample project budgets or sources and uses of funds, uses and sources of funds. And we're going to start with one for an existing business. And this is a remodeling company that wants to add equipment and to add and equip a cabinet making shop, to increase their revenues and basically expand their business a little bit. So here's kind of what they've done. They've gotten some price quotes and some bids, and they found out that they need to purchase about $55,000 of equipment. It's going to take another $3,500 to install some of it. They're going to do a little bit of leasehold improvements for that equipment. They have to add a little bit of additional electricity, maybe move some things around in their building. And if they're adding this cabinet making shop, they're obviously going to need some inventory so that they have some starting inventory to make the cabinets as they go forward. And of course, we can't forget the loan closing costs that any lender is going to charge. So, but let's say, so they know that their total uses of funds, their total budget is going to be $82,100. Now, they only have about $40,000 in their business checking account. So where might that other money come from? And can we have the next slide? And so now we've kind of like we developed our uses of funds. Now we're going to look at our sources of funds. So since they are an existing business already and they're fairly profitable, they're going to qualify for a bank loan. So they approach their lender, their bank, and the bank says, you know, we can lend up to 57,000. So we'll approve a loan for your business for 57,000. And that's really not enough for our company to want to do. They would deplete too much of their cash in their checking account. So they approach a nonprofit lender like an NDC or an Metropolitan Consortium or another lender, another nonprofit lender in the community. And that lender is willing to provide them with another 15,000, which means that as a loan, which means that now they can, the rest of it, $10,100 from their equity is enough to complete the project. So again, you can see that their sources and uses of funds match, and they don't have to deplete all of their cash in their checking account. They can still keep that some of that for their operations. So you can see this is how they've put together their project budget. They figured out what do they need to build out that cabinet making shop, and now they've got the money approved and where it's going to come from. Next slide, please. Okay, so now we're going to look at a sample project budget for a conversion. And as any of you who have attended the last webinar that Patty Viafra did, she talked about business conversions. In other words, where a small business owner or owners want to sell their business for whatever reason, they're retiring or they have another plan, and who the best buyer for it would be is a group of the existing employees who want to form a cooperative and buy that business. So this is an example of a small cleaning company owned by a married couple that sold to a group of its employees. They had to move to another state for their own reasons. And they determined that sort of the purchase price of their business would be $250,000. The business needs some working capital. The new worker owner co-op needs some working capital. They need to, in other words, to have some money in their bank account to pay bills until the sales start coming in. And again, we have to be sure that we have money budgeted for the closing costs. And next, this is actually based on a real company that Nexus worked with. And others as well. They worked on figuring out a reasonable purchase price for the business. What would be needed to sustain it in the long run, helping the new worker owners who are not just workers now and employees, but also owners, how to organize, govern, manage, and operate that business. And finally, how do we put together the financing to purchase it? I do want to talk a little bit about the purchase of business assets. So what is it that this worker owner co-op is actually buying? Obviously, it would include any equipment, furniture, fixtures, the business name, which has some value if it's got a good reputation in the community already. They're buying the customer list, which is important for the cleaning business. And they're also buying really the value of the income stream, of the profits of that business. Because hopefully if the business is doing well, the new worker owners will be able to keep that up. And so that would allow them to build their own wealth and to provide for their employees as well. Can we have the next slide, please? So how did this worker owner co-op finance this business purchase, this project? Well, they were able to get a loan from Shared Capital. And that is Shared Capital is a nonprofit lender that makes loans exclusively to cooperatives. They happen to be based in St. Paul, but they actually work throughout the country and finance cooperatives throughout the US. And in this case, the seller also provided financing. So what that means is that the owners basically did not receive all of their purchase price on the day of closing. Rather, they agreed to sort of finance part of that sale themselves. And that's actually not that uncommon when an owner is selling a business. They often will take back a note or finance part of that purchase themselves. And so that could be structured in a number of different ways. It could be termed out just like a regular loan, or maybe termed out for a couple of years, and then there's a balloon where the cooperative then gets financing to pay that seller off down the road. It all depends on what is negotiated. But the seller financing also gives some confidence to that first lender, shared capital in this sense, because the seller is standing behind that purchase price, because the new co-op has to be able to pay the first loan, the shared capital loan in this case, as well as the seller financing. And the seller is saying that he has confidence, or they have confidence, that the new owner can do that. So again, our sources and uses of funds match. So, okay, let's move on to the next slide then. So this is the final example of a project budget, and this is for a startup business. In this case, it's for a startup coffee shop, and it's also based on an actual coffee shop. And this particular owner of this coffee shop is very lucky, because they have found a space that was used as a coffee shop before. And so they don't have a lot to spend money on. They have to get a couple of pieces of new equipment, maybe do a little bit of leasehold improvements, maybe do a little electricity upgrades, maybe do some painting and wallpapering, stuff like that. It's because this whole project cost here is only $65,000. Now, if they were going to start like a Dunn Brothers franchise in a space that had never been used as a coffee shop before, you're talking maybe $500,000 to $750,000. And our person here only has about $15,000 to $20,000 of equity. So they had to find a place that basically they could move into with just a little bit of cost. And it actually, in this case, it took this person about 2 to 3 years to find that perfect space. But again, it worked out for them. So they got some bids for the equipment. They got a small bid for the contract for the leasehold improvements. They needed to have some additional inventory, or initial inventory, had to pay the rent deposit on the space, needed some money to have in the bank for working capital so they could pay their bills until the sales came. And of course, we have our loan closing costs. So can we have the next slide? So where did this owner get their funding? Well, because it was a fairly small project, this particular owner had a lot of experience in operating. He was a manager at a coffee shop, had some food business, restaurant experience. So had decent credit, didn't need a big loan. A bank was willing to give them $35,000 to start. They went to a nonprofit lender to get an additional $15,000, and then they contributed their equity of $15,000 that they had been saving for the years that they were looking for a good turnkey space. And so again, their sources and their uses match. So they were ready to start the business. Can we have the next slide? So just a couple of things to keep in mind, especially if you're a startup business, is never, and this is based on my experience working with a lot of small businesses over a year, you should never, ever sign a lease or start work on your project until you have all of the money you need committed and approved. I can't tell you how many people I have worked with over the last 40 years who've signed the lease, didn't have any of their financing put together, and end up having to spend lease payments every month for 6 months or even up to a year while they're trying to put their financing together. And all that money could have been, you might as well just taken it and thrown it off the Lake Street Bridge into the Mississippi River for what good it did. So it's best to wait until you have everything put together before signing the lease. You also want to get firm bids, quotes for equipment, furnishings, leasehold improvements to make sure, and from reputable vendors and contractors. So you really are comfortable that you have all of the costs budgeted for. And then you also want to make sure you have enough cash budgeted for working capital. So you have enough money in the bank to be able to pay your bills as the business starts and moves forward. And I think before we go on, I just wanted to know if we have any questions. You can put them in the chat at this point before we move on to projections. And otherwise, I will continue to the next slide. All right, so we've talked about our uses and sources of funds already, our project budget. And now what we're going to do is we're going to talk about projections and specifically lenders, if you're going to go out to get a loan of some sort, and even just for your own sake as a business owner, you want to have good monthly cash flow projections. And you also want to keep in mind all of the detailed assumptions that you are figuring out for those projections and keep track of them. Write them down someplace and keep track of them so that if you change them going forward, you know exactly, you'll be able to track those changes as well. So if we can have the next slide. All right. So one of the first things to keep in mind about projecting cash flow or just from operating a business in general, from a financial management perspective, the most important thing to know and manage in your business is cash. It's not necessarily making the coffee or getting, making the breakfast burritos like our coffee shop or making the cabinets for our cabinet maker. It's really managing that cash. Because if you don't have cash, you can't pay your bills and you can't continue with your business. Next slide, please. So projecting cash flow, basically this is a very, very simplified version of what a cash flow projection is. Basically, you're monitoring every month or projecting out, trying to estimate every month, starting with what beginning cash you're going to have in that business checking account at the beginning of the month, how much cash is going to come in from whatever sources it's going to come in from, what cash has to go out every month for payroll, for rent, for utilities, all of those expenses, and then what cash is left at the end of the month. And then that ending cash is the beginning cash for the next month. And so you're really just trying to figure out, is your cash going to grow? Is it going to be enough to pay all your bills? And ideally, you would want to continue this out for the whole 12 months, but the slide only can hold about 4 months. But basically, you kind of want to do it for the full 12 months. Next slide, please. So where can cash come from in a business? Basically, there are 5 main areas that it can come from. The most common would be cash sales. And I include credit card sales on this because credit card sales do come into the bank account very quickly in a day or two. So cash sales. So it's like back in the day, you'd go to a retail store, you'd buy an outfit or a dress, or you'd go to Target and you'd buy something. You would pay cash, you'd write a check, you'd use your credit card, and you'd leave with that. And that money gets into the business bank account pretty much right away. Then there are collections from accounts receivable. And I've got a quick definition there in the box, but I'll give you an example of one. Let's say your business is a manufacturer. So you take all of the month of January to make this product that you're going to sell to your customer, and you're going to ship it in early February. Your customer gets it a little bit later in February, and when you ship it, you also send them an invoice, and then your invoice usually has to be paid in 30 days. So sometime in March, your customer is going to pay you. And so in the meantime, during February, during January, you are paying for raw materials, you're paying for payroll, rent, all of your other expenses. And basically, you're not going to get that money until March. So that is something that you want to keep track of. If you have that type of business, it's really, really important to make sure that you have projected out your cash flow because you don't, just to make sure that you have enough cash to be able to make your product until you get paid for it. The third way of getting cash into the business is from the owners. Basically, they're going to contribute their cash equity, like we've seen in all 3 of our examples, that we have some cash equity going in from the owners. And if the business, even after it exists and has been operational for a while, if there's some times when cash is a little low, sometimes the owners have to put in more money in order to make sure they can pay all their obligations. Loans are the 4th way of getting funds into the business. Each of our project sources and uses of funds had loans that were needed either for working capital or for equipment or whatever. And then grants sometimes can be a source of lending. Sort of before COVID, there were no small business grants of any sort that I was aware of. People would ask about them, and we'd say there are no more grants. There are some now, and Christina will be talking about the local fund and its grants at the end of our presentation here. But usually grants are often limited, and they also have strict eligibility criteria. So it is not always something you can rely on. So let's do the next slide. And I want to use a home health care example of a cash flow to talk about accounts receivable a little bit, and to talk about why doing a cash flow projection can be really, really important for your business. So a home healthcare business, in a nutshell, it's a small business where the staff are personal care attendants or nursing staff or whatever. They provide homemaking services, maybe do some minor food prep, make sure the client will take medicine. The clients tend to be elderly people, vulnerable adults, people with disabilities perhaps, that can't just take care of themselves. They need some additional help, which the personal care attendants or the home health care company will provide. Most of those, but even though the client is provided the service, the bills are paid, the services are paid for either by medical assistance, which is like Medicaid here in Minnesota, or insurance companies, typically. And so, and sometimes those can take a little bit of time to pay. It's also a very complicated billing system. And if you make a mistake, if you're a new business owner that doesn't have much experience, it's very easy to make mistakes in terms of the billing. So it can take a really long time, at least initially, to get paid. And in this case, the example I'm going to show you is, here's a business, a home healthcare business that also is growing. They're doing good work and their sales are increasing. They're getting more clients every month, but you can see they're kind of overdrawn at the bank. So let's kind of walk through this quickly. So they start out with beginning cash of $2,000 in January. They make sales of $2,000, which means at the end of January, they bill medical assistance or an insurance company or a combination of all that, $2,000. So they have accounts receivable of $2,000. They have to pay their wages and other bills of $1,000, and they get no cash in, so they end up with $1,000 at the end of January, which is what they start in their bank account in February. Now they've messed up their billing system, so they get no money in February. The state says, or the insurance company says, no, you made some mistakes here, you got to redo this. In the meantime, they've added clients, and now at the end of February, they have sales of $4,000. They're going to bill the state and the insurance company another $4,000. So now their accounts receivable are $6,000. The state and the insurance company owe them $6,000. They've had to pay $2,000 out for their staffing and expenses. Now they're in the hole by $1,000. And you can kind of see that continues on for the rest of the 2 months in March and April. And if you look at their total sales, I've totaled it, $20,000 for the first 4 months. Their actual expenses are $10,000. So they're hugely profitable, $10,000 of profit. And yet they have no money in the bank. In fact, they're overdrawn by $2,000 because all of that money, or a good chunk of it, $14,000, is owed to them by the insurance companies and medical assistants. So from this perspective, if they know how this is the way it's going to operate, and they can see that on paper first, they can make sure that they have more money in working capital in the beginning, so that they're not going to run out of cash. Or they can also know that they have to really be very, very careful how they grow, and maybe they can't take on all of these clients at once. So again, this is somewhat of an exaggerated example, but I do know that startup home healthcare businesses that I've worked with do have trouble. They don't grow this fast, but they do have trouble with their collections initially, and that has gotten them into a lot of trouble. So So knowing if this is how your business operates, it's important for you to make sure that you have enough cash or that you monitor that cash very, very carefully during the first few months until, everything starts working out and it's flowing. So I'll just pause there just in case anybody has any questions. And if not, we can continue on to the next slide. So how do you project cash flow, especially if you're a startup and you're not really sure? Well, there's some steps you can take, and we'll walk through some of them in the next couple of slides. So the first thing you want to do is you want to estimate your cash sales for every month. And we'll talk more about this in a little bit. But you also want to think about, especially for your cash flow, is there any seasonality to your business? Like, is it bigger in the summertime than in the wintertime? Like if you're a landscaper, you're going to have more revenue in the summer than you would in the winter. Again, even with retail businesses, there's seasonality. Are there certain days that are slow, certain days that are busy? You also want to estimate what cash payments have to be paid each month. Now, some things like your rent, your utilities, payroll are all pretty typical. But then there are some things that may only need to be paid a few times a year, and you want to know when those have to be paid, because then that could have a bigger hit to your cash flow. An example would be insurance. Does your insurance company require a down payment? Do you want to pay them annually? Just to kind of get a discount or whatever. Maybe your license is due annually. If you have to pay real estate taxes, they're due, half is due in May, half is due in October. You need to budget for that in your cash flow to make sure you have enough money in those particular months. You can do research by talking to vendors, getting price quotes from your insurance agent, things like that to kind of figure out how you can budget for them. I also want to mention payroll. If you pay your folks every 2 weeks, there are going to be at least 2 months, possibly 3, where you have 3 payrolls in that month. And that could be a potential hit for your cash flow, especially if your revenue is relatively consistent from month to month. So just some things to keep in mind as you do your projections. Next slide, please. So we're going to look at the case study of our startup coffee shop and kind of walk through how he might project his cash and credit card sales. We're considering, again, credit card sales as being pretty much like cash sales. So he'd want to think about his menu. What is he selling? In his particular case, he's selling the typical coffee drinks, espresso drinks, and some non-coffee drinks. He's going to serve some pastries, and he's also going to serve things like breakfast burritos, maybe some breakfast sandwiches, things like that. So he's going to set up his menu. He's going to think about his pricing, sort of what are the prices for each of those items. He wants to think about how much might the average customer spend. Now, he's had experience managing a coffee shop, so he kind of knows that already from the years that he spent working in a coffee shop. If he hasn't, then what he'd want to do is go visit his competitors or other coffee shops, sit there various hours of the day over several days and kind of pay attention, like what are people ordering? How many are just taking coffee? How many are ordering bigger orders? And kind of like figure out from that research, what are the busy hours? How many customers are coming in every hour? What is the average that they're spending? Then he wants to think about his own shop. How many days will he be open? How many hours per day? Is it going to be 12 hours, 8 hours? Can he afford to cover all of those hours with staffing? Those sorts of things. So this is all part of the research that he's done for his business plan. And again, he wants to keep a record of those assumptions just in case he wants to change them. Next slide. So this is how he could translate that information into his cash flow projection. And I do want to say these numbers are a little bit old, so I'm not sure that they would be as accurate today because we did this a few years ago. But he had determined that his average sales per customer is going to be $8 per customer. Some just going to order coffee, some will order more, but it's going to come out to about $8. He figures that he's going to start out with about 50 customers per day, which isn't that much if you think about it. He should be able to handle that pretty easily. However, as word gets out about his coffee shop, he's expecting that will increase. This is kind of a guess. but it's an educated guess based on his experience, based upon his research. He also is going to be open pretty much every day of the month, except for the major holidays like New Year's, Thanksgiving, Christmas, those sorts of days. He's not going to be open. So by just doing some simple math, some simple formulas, he's going to project that his first month, he's going to do 12,000 in sales. Month two, 13,440. Month three, 16,120. And obviously he would want to continue that out for the full 12 months. Okay. Next slide, please. So how might he project the cash expenses? Well, he'd kind of do the same sort of thing. And again, this is cash out. So again, he's going to think about his menu and he's going to think about the cost of the inventory. And I've used the word COGS here. That's cost of goods sold. So if he sells a breakfast burrito, what are the costs for the eggs in that and all of the other ingredients? If he sells a cup of coffee, what is the cost of the coffee as well as the paper cup and any of the other disposable items that are in that? And he can get that information by talking to like coffee roasters, restaurant suppliers, that sort of thing. He can look at what the industry is doing. That would be part of his research for his business plan. Our particular person here kind of knew, worked in the business, knew all of the vendors, so it was relatively easy for him to figure that out. If he has employees, how often do they get paid? What is their wage going to be? What is his monthly rent? He can get that from the lease. Insurance, how often is he going to pay that? Is it going to be monthly, quarterly, annually? He can talk to his landlord about what he can expect to pay for utilities and then all of the other expenses. If the business needs a loan to start, he needs to also figure out what the monthly loan payments might be. So this is just a few examples of the expenses. There's going to be some additional ones, but I'm hoping that just gives you an idea of sort of the work involved and the steps involved in figuring those things out. Next slide, please. So again, this is how he might translate that into the cash flow projection. So this is his cash out. So he was estimating that inventory is going to be about 30% of his sales. It's probably a little bit higher now. Eggs and coffee are going through the roof, so this is a little bit old, so I'm guessing that might be higher now. He is going to hire some part-time staff. So he's figured out how many hours they're going to work. He's got a schedule that he's put together for them. He's figured out what he's going to pay them per hour. He also has to pay payroll taxes, which are his share, the employer's share of Social Security, Medicare, and state and federal unemployment insurance. So there's a cost to your employees up and above the wages you pay. He also needs to have insurance, business liability insurance for sure, workers' compensation insurance for his employees. And he's got equipment and things he owns, so he probably wants to have some property insurance that would protect that equipment in the event of a fire or some other damage. He's going to get a loan, and he decided that he wants to pay all of his insurance up front. So that's kind of a big hit that first month, but it might be then he doesn't have to worry about it. It's all taken care of for a year. Maybe his lender says, I want to be sure that you've covered it for a year. I don't want to have to worry about it. Or he gets a discount. He could also spread it out if he wanted to again, he has to figure out what would be better for his cash flow. He's got a loan payment, but he's talked to his lender, and his lender's going to give reduced, maybe interest-only payments for the first few months. So it doesn't have to be as big a payment until month 3 when the full principal and interest payment comes out. And then he's got rent, which is pretty steady, his utilities, and then we just put a little miscellaneous in just to have a little bit of a cushion. So now he has just totaled that, and this is what he thinks is projecting what his expenses are going to be, the cash expenses that he's going to have. Okay, next slide, please. All right, so now we're putting it all together. So we're not done yet, but we now have the cash receipts, basically that 12,013,440 that we've just calculated a few slides ago. We see it show up as sort of the cash receipts for his business. And we see the expenses that he's going to have to pay out every month, the inventory, the wages, and so on. We see those going out. Now, he's not in the gross wages at all. He's going to be taking an owner's draw, but he's going to be the last to get paid. If there's money available, he can take a draw, which he would then use for his own personal living expenses. If there's not enough money, everybody else gets paid first and then him. So hopefully he's got a spouse or a partner that can help support the family until he's got some cash flow. Okay. All right. So we've done that. So now let's finish it up. So if we can have the next slide, please. Okay, so now what we've done is we finished this up. We've put in his beginning cash. So he's hoping to have $5,000 of big cash in the bank account for the business when he starts the business. And so he starts out with 5,000. He's hoping to sell and bring in cash of 12,000. So he should have $17,000 of cash available to pay all of those expenses. So he pays 13,490 at the end of the month, and he should have $3,510 left at the end of the first month. That becomes his beginning cash at the beginning of the second month. He hopes to have sales, cash sales of 13,440. So 16,950 to be able to pay bills. And then he's going to try to get a little owner's draw in here for $500. But at the end, he's spending out $12,072, and he should have $4,877 left. It's a little bit more than he started out with. That's a good sign. And we kind of do the same thing for month 3. And he's got even more ending cash, $6,094. And again, he would continue that out for 12 months. And if he's applying for a loan, he does need to continue that out for another 12 months. So it should be 24 months altogether. So then some of the things to look for in the cash flow projection: when does cash start to go up rather than going down? For him, it's going to go up, we hope, pretty quickly because his is a cash business. Everything is cash or credit card sales. But sometimes with some businesses, it could take 4, 5, 6 months, and the cash is going to go down before it kind of goes up again. That will help you determine how much cash do you really need to start with to have enough of a cushion, because in case you don't actually meet exactly the projections that you have. And so one question that I would ask you to think about: do you think these are reasonable projections? If you were doing these projections, would you do anything differently? One thing that I would do is, like, this is a little skinny for me. I would want him to have $10,000 of beginning cash just to have that cushion, just in case something happened. There was a snowstorm when he started and, sort of his revenues are down. You just want a little bit extra to have. All right, next one. Thank you. Okay, so what causes low or negative cash flow? So a couple of things to keep in mind: the timing of receipts or disbursements. We talked about the home health care where, it takes a while to get those receipts in. Also, too, when do you disperse money? If it's things like real estate taxes, that's twice a year. So big chunks of money going out a couple of times a year. Again, collection problems. Again, going back to the home health care. Are you getting paid for the invoices that you are sending out? This is a bigger one, this next one: a deficit in operations. Are your expenses always larger than the cash coming in? If that's the case, there's a problem. And you have to figure out either how are you going to increase your revenues, your sales, or how are you going to decrease your expenses? Can you cut back on anything? Can you reduce your labor costs? Can you do something, or a combination of both of those? Because if your expenses are always exceeding your revenues or your sales, you're going to be, going out of business. Unexpected events that might affect income or expenses. And we've seen a couple of them in recent months. Egg prices going through the roof affected our coffee shop. And this guy was calling me like, should I raise my prices? My costs are crazy. Yes, coffee. If you've gone to the grocery store recently, you found that coffee is going through the roof. Again, that's affecting him that he doesn't have a lot of control over. So then how does that impact his business, and how is he going to mitigate those impacts? raising prices, cutting expenses someplace else. And then changes outside of your control. And one thing would be like if the city tears up your road, the road in front of your business, that is going to have an impact and you don't have much control over that. So what can you do? Again, how do you try to market so that you can make sure your customers still come back? Are there other places that they can park, other ways they can get to your business? Can you go to your lender and say, hey, can you put us on interest only for a while until the road is repaired? So again, you want to kind of both in your projections and as you monitor your cash flow, make sure that you're aware of some of these things. Next slide, please. Okay, so just some management practices, both for projecting your cash flow and for managing your cash flow. Again, write down your assumptions so you don't forget what they are, so that you can update them or change them as necessary. You ideally, it's not easy to do when you're busy running a business and doing all the other things you do in your life, but ideally you'd kind of want to update the projections with actual figures every month, just to kind of see how they're doing. And then at least modify and update the projections as you get better information. Focus on the big variances. And that might be like, coffee going up or, tariffs, how are that going to impact things? And then try to keep an eye out for any new concerns or problems, such as if the roads are going to be torn up. And then you want to also monitor your cash flow continually and take timely action and look for those patterns. Is cash continually going down? Is it trending up? What's going on sort of over the past few months? And see how that might impact the future. Next slide. And then just a couple of tips. Again, if you are like a home healthcare business or you have to invoice customers and they'll pay you 30 days later or whatever, invoice them promptly at the last day of the month or the first day of the next month, and send that invoice out. Collect deposits if you can. If my coffee shop person wanted to rent out the space for an event, to customers, collect a deposit on that. Don't wait till the end to be paid, because what if they don't pay you in a timely manner? Get a down payment. Offer discounts for payments in advance if you invoice customers. Review your accounts receivable frequently to make sure nobody's getting too far behind and to make sure you call people or nudge them to pay. And again, don't let late payers get too far behind. Again, that depends on your type of business. And also you want to hang on to the cash that you have. So monitor that cash flow, see if you can find any patterns in it. Build a cash reserve. Ideally easier said than done, but it's always good to have for a rainy day or when something happens and you need that extra money. Consider the timing of the payroll. If you're finding that every other week causes you some problems at some point in time or a lot, then maybe twice a month might be the best way of doing payroll. And then you can always request longer terms from your vendors and request installment payment from your vendors if you get into a tight situation. They usually will work with you, but you can maybe stretch them out a little bit. And remember the old idiom that cash is king. It's important because that's what you need to pay your bills. And I think that's it, other than questions or comments or any concerns or anything that has come up as people have as we've gone through the slides.
I have one question that came up when I was talking to somebody last week, Mara, and I promised I would ask it on this call. And it was when sometimes if you've already started your business, so you already have had cash go in and out of your drawer for a few months, how do you sort of start a cash flow projection kind of midstream? Because
Oh,
that seems to be really intimidating for folks.
It actually should be a little easier because you
Oh,
have history now. So you would just start with the next month. I wouldn't go backwards. I mean, you could go backwards and kind of actually show the cash in and cash out from your bank statement if you wanted to. You could do that, but it might be that would be the ideal. But I think even just going forward, starting with whatever that cash balance is, for the next month, and then with the knowledge that you had about sort of what money is coming in from sales, what money is going out, just go forward and then kind of monitor the actual cash in and cash out against that. And to see, are you doing better than you projected, like you're projecting, or worse? And then adjust going forward. So I think it's actually slightly easier, even if they only have 2 months. And I think it still could be very helpful because now they have a little bit, not much, but they have a little bit of history. And now maybe this helps them focus a little bit more carefully on the areas they should be a little bit more concerned about.
Okay, I have one more if nobody else has any, but I want to pause and make sure I'm not crowding folks out. Okay, so this one was this was a concern that somebody mentioned a while back. What happens after grants dry up? So it made me think of it because you mentioned it today. Luckily, I get to talk about an awesome grant today, so I get to ask this question and then feel good. But here was a question. Let's say grants dry up. I'm going to do this project, no grants. Is there a formula, or should I think about if I want to get a loan from a grant or if I want to get a loan from a bank or a credit union? Is there some percentage of money I need to borrow from friends or have saved up? Right? Is there a formula like I need to have 10% in cash if I want to get a loan from a bank? That
Yeah.
kind of thing to think about.
Yeah, I mean, back in the day when I started, it was like 25%, 25 to 33% down. I think that's loosened up quite a bit. And I would say the magic is about 10%. But again, it depends. It depends. It depends on how big a loan you're looking for. Our coffee shop guy, $65,000 project. It's a small project. He actually had probably a little bit more than 10%. And it's a small project, bank's willing to take a risk. If it's like the big coffee shop where you need $500,000 to start, you're talking probably more than $50,000. So I think 10% is the magic, but it also depends on that the owners, because they're going to be guaranteeing the loan, the owner's credit score, the owner's strength. Do they have other resources to call upon? So, so 10% I think is the magic. It might be more for some people, but even banks are even accepting 10% as well. But again, you should be prepared if the credit is not so good, then you might be prepared to put in a little bit more.
All right. Deanna, do you see any other questions before? Okay. Well, on that note, let's go to the next slide. Speaking of grants, see how I teed that up, right? That's the magic of a good webinar. So I want to talk with you all folks. At the top of the hour, we talked a little bit about the local fund. So we are really excited and honored to have been chosen by the City of St. Paul to bring to you the local fund for shared ownership. It is a partnership between Nexus Community Partners, where we work here at the Shared Ownership Center and the City of St. Paul. The local fund exists to leverage $2.5 million to support worker-owned cooperatives and community ownership of real estate in the City of St. Paul, Minnesota. I'm also going to read the fine print, which I know will make Deanna happy. This project's being supported in whole or in part by federal award number SLFRP 1612, and it was awarded to Nexus Community Partners by the U.S. Department of Treasury. So with this grant fund, we are able to provide technical assistance, training, resources, and direct cash grants to organizations who are either startup worker-owned cooperatives in the City of St. Paul that are BIPOC focused. We are also able to provide support and potential grant funding for existing owners of businesses if they are located in a qualified census tract area who are converting to worker-owned cooperatives. We also, and there was a great question in the chat, and I'm glad they saw my answer, here to support mixed use or commercial real estate, cooperative real estate endeavors as well. So this fund is available through September of 2026. We do still have grant funds available, and we're very excited to talk more with you about this grant fund. So let's go to next slide. And here's how you can learn more about it. So if you want to learn more about the local fund, again, it is a St. Paul project. So your business would need to be located, or the real estate project would need to be located in the city of St. Paul. If you're interested in learning more, please fill out the inquiry form. I think we have demonstrated well. We all love talking, and we would love to spend more time with you learning a little more about your project and seeing if we might be able to support you in your cooperative endeavor. So fill out the form. We'll reach back out to you. Happy to answer questions one-on-one, and we can talk more about the St. Paul Fund in detail. All right, next slide. So as we mentioned, this is our training roadmap. You have journeyed with us. Congratulations. We have done this together today. So we have completed webinar 5, projections, sources, and uses. And our next webinar, and I'm going to ask Patty to talk a little bit about it since she's here today, is access to capital, which I'm really excited about. Patty, could you talk a little bit about our June 18th webinar?
Yes, we're really excited to have a great panel join us on June 18th to talk about capital available for cooperatives. We're going to have Shared Capital join us. We're going to have the Metropolitan Consortium of Cooperative Developers join us, MCCD, and Neighborhood Development Center in DC. Join us as well. It's going to be they'll share the type of capital they have available, how to access it, what makes a good application. They'll share how they approach relationship management. So it's really a great opportunity to kind of bring it all together. We've been building from business plan to creating your cooperative, projection, sources, and uses. All of this leads to applying for a loan or a grant. You'll hear more about the local fund. And so if you are available, please join us on June 18th at the same time. It is a Wednesday at 3 p.m. We'll be kicking that off.
Terrific. Thanks so much, Patty. We're really excited about that. We hope you will join us. So with that, we are really grateful that you all have been here, and I'm going to extend to Mara the final word today.
All right, well, if anybody should feel free if they have any questions as they're doing a cash flow projections to let me know. I love working on spreadsheets, so I think spreadsheets can solve just about any problem. I'm a little crazy that way, but yeah, people should feel free if they have a question and working on a spreadsheet, feel free to, or cash flow projections, feel free to reach out to me.
Excellent. All right, everyone. That's the end of today's webinar. Thank you so much for joining us. We're really glad to have you here, and we look forward to seeing you again. Take care. Bye.
Thank you.
Thank you.